Check this out, apes. According to the SEC, broker-dealers should collect margin from counterparties to the fullest extent possible. They add concentrated positions pose particular concerns. Now, did they just show their hands? Well, with the data here that I'm going to go over in this video, it sure looks like it, because we just got the margin data for the month of February, and even though the markets were in the toilets, the margin debt actually went up. This should not be happening. But what does this mean? As stocks go down, margin goes up. I think that means you're going to be looking at an even bigger credit crisis than I even thought. So I'm honestly shocked. When I woke up today, was doing due diligence, catching up on everything I missed over the night, and to see that, that's the last thing I expected. So I want to talk about that. I want to briefly talk about the whole Citadel's assets being frozen debacle that some people have talked about, and give you guys my positioning on that, as well as I do want to talk about heading into next week, what this quadruple witching day really meant for Friday, and why you've seen AMC stock go up 1.5% in after hours on some very good volume, because typically this does not happen, specifically seeing this kind of volume here in after hours. So you're going to get a lot of value out of this video. The only thing that I ask is that you hit the like button, subscribe to the channel, and comment down below what is your opinion on all of this information, and come join the trading community if you guys want to be a part of that and get up on some of the best trades that will make you money for a very inexpensive cost. Like I said in the last video, I'm probably going to raise the price here soon just because it is so inexpensive. But let's get into this video. So why is the SEC telling broker dealers they should collect margin from counterparties to the fullest extent possible? Well, it's because there's a lot of over leveraging going on at the same time as a lot of assets are getting devalued in massive ways. You're seeing banks that have a lot of exposure to Russia. You're seeing the European economy slowing down dramatically, almost heading into a recession as we currently speak. You see the China markets in turmoil, with the China Shanghai index at its 10-year lows. It has bounced up just a little bit, but it's still well under March 2020 levels. And if the pandemic gets worse over there, which it looks like it's inevitably going to, given their close proximity to each other and how many people they have, it could get a whole hell of a lot worse in China as well as around the world. So you're seeing assets getting devalued, you're seeing a very shaky global market, and you're also seeing margin debt that is not going down. And like I've said before, with this margin debt, if you take a look at January, it was at $829 billion. In February, it went up to $835 billion. But what you'll notice is the highest margin debt that we have ever seen came in October 2021 at $935 billion. So we've went down about $100 billion of margin debt. But that was really retail investors. That was really your retail guys. Whereas, a lot of you guys, if you were using margin and you've seen your stock portfolio go down dramatically, some stocks down 90%, you had to cover on that margin debt. You had to get rid of that, or you had to deposit more money if you had enough money to cover those margin calls. So really, the big guys here, they're still as over leveraged as they ever have been, but even more so now, because the asset values of these securities, these treasury bonds in Russia, these banks that have bad debt from Russia, China markets, European markets, all of that going down and margin going up means that margin calls can come a lot more frequently and for a lot smaller of a move. It really doesn't take a big move when you're seeing that divergence going on to see massive amounts of margin calls. And the SEC also says they add concentrated positions pose particular concerns. And why are they saying this? They're basically saying that you have too many concentrated short positions in a lot of stocks that are already beaten into the ground. The odds of AMC falling to $5 is much lower than AMC going up to $25. Much, much lower. We've already fallen so much. AMC is at that fundamental valuation. So if you're continuing to short these stocks without de-risking your portfolio, slowly but surely, as you're actually winning on these short positions, you're inevitably going to lose. And we know that shorts are not slowly de-risking their portfolios. Each and every single stock that I look at on Ortex sees the short interest going through the roof, and as the stock price has been falling, the shorts have been increasing, meaning that I think there's a lack of actual sellers of AMC stock at this point, and a lot of that selling power is really artificial selling power because it's just a lot of shorting that has been going on. And as you can see, the short interest of free float is 21.23%. Current shares that are sold short of 109.38 million. Cost to borrow max of 2.32%. Utilization of 100%. Days to cover of 2.29. The situation here does not move around all too much, but the short interest continues to consistently climb to the upside. Now, well over 20%. Just a couple of months ago, we were struggling to get to 20%. We would go to 20%. Ortex would revise us back down to 18%. Now we're getting confirmed at over 20% as of February 28th. So if shorts were smart, they would slowly be covering on these short positions as they have beaten these stocks into the ground, because like I said, it's going to be a lot easier for AMC to go to $25 from here rather than to go down $10 and go down to $5 from here. It's simply not going to happen unless you see a mass panic event. Why? Because AMC actually has a business behind it, and a damn good one from my perspective. And we've went over exactly why I feel that way. But at the same time, a lot of this actual selling power is just shorting power. It's artificial selling power because, as you can see, as soon as AMC started to really go down, around $40 per share, started to plummet into the ground, you've seen the short interest just go through the roof. And you're seeing this on all stocks. So that margin level, that safe margin level, right, where the margin debt is going up, asset values are going down, that's getting a lot smaller. So when you inevitably see the shorts be forced to cover, it's going to be a very, very violent event, and you want to be a part of it. That's not something you can try to time, because it'll likely happen over a catalyst, a news headline, or something that triggers mass short covering. Now, I do want to talk about this situation with Citadel's assets being frozen. And this happened during 2008. Citadel's hedge fund, they barred investors from withdrawing money. That would be Citadel's assets being frozen. Now, there's a lot of talk about this investigation that is going on, this probe. Is that going to freeze Citadel's assets? And probably not. Probably because that would undermine the markets, and that would really highlight a big issue here. And the last thing that SEC wants to do is highlight a big issue with their precious, perfectly run stock market, right? I hope you guys get the joke here, because it's not. It's far from perfectly run. There's a lot of manipulation that goes on, but they're probably not going to bar or freeze Citadel's assets. But people also must remember that there is a market maker here. Citadel has a hedge fund and a market maker, and the market maker has been quoted too big to fail. Now, we don't actually know if that is the case because, one, we've never seen a market maker on this scale that is doing this kind of fraudulent activities fail, but we've also never seen a market maker doing this level of fraudulent shit, one, come under investigation, but also be willing to take the back ends of all of these losing short positions in the end. They will lose. Who knows what happens when you see all of this come to a head? We've never seen that before. We've never seen that before with a market maker. So we'll have to wait and see. Time will tell exactly how that will pan out. But as of right now, Citadel's assets are not actually frozen. Now, last thing that I do want to talk about is the quadruple witching that we seen on Friday. That was March 18th. We have another one June 17th, September 16th, and December 16th. By far, March 18th is going to be the biggest one of this year, followed by June 17th. Also going to be a decent one, but March 18th was definitely the big one. And there was $3.5 trillion of notional value that did expire. So what does that mean? When you sell calls, when you sell puts, that goes to the notional value of an option expiration. And essentially what happens is that money is kind of locked up in those option contracts. You have a lot of money locked up, $3.5 trillion. So I actually think it's going to be a bullish reaction from the markets when they're able to reposition that money into more options to buy stock, to do whatever they want to do with that money. It could also be a bearish reaction, as some of this money was obviously squeezed out, and you did have to see a lot of shorts get assigned on positions, some shorts covering across the board. That's why you have seen this explosive move after the Fed. But by and large, I think it'll be a positive reaction. And I do want to talk about the positive reaction to AMC stock here in after hours. We went from a low of about $15.60 here in after hours on Friday, all the way up to a close of $16.05 per share. And I'm sure a lot of you guys have probably not got assigned on options before, but I have. And it typically happens in after hours of that trading day. So that's why you've seen huge volume here, a 63,000 volume candle right there. And even the last candle was over an 8,000 1-minute volume candle. And a lot of these candles are in between 2,000 volume and 20,000 volume. Lots of volume here in after hours. So a lot of people that had losing positions on AMC had to get assigned, and that should help solidify that floor here, because you've seen the $15 contracts, which was the main level. You've seen the $16 contracts expire in the money. So that should mean a lot more stability heading into next week and really solidifying that $15 support level. Now, just some brief technicals here as well. At $15 level is key. We closed above that, which does look very good. The next level we have to break out above to really see a bullish reaction is the 50-day moving average. We have not even been above this or even close to this since November. And now that is sitting at $17.49 per share. If we can break out above that next week, then really the next major moving average is up here at $25 per share. And we've been in this range in between $15 and $21 for a while. So once we break out above that, I think that's when you really start to see some shorts get panicked, and a lot of that over leveraged activity going on will start to really negatively affect the hedge funds, institutions, as well as the market makers here. So that's key. The 200-day moving average is up here at $34 per share as well, and that will inevitably be the level that we will retest. The RSI is sitting at 45.93, so pretty neutral. It's not oversold, it's not overbought, it's really on the neutral side, slightly on the oversold side, considering neutral is 50, we're at 45, so it's kind of on the oversold side still, but we have definitely seen a decent bounce. What I really want to see is volume. When that comes back into AMC stock, that's when you're going to see the stock just go absolutely insane. We've been seeing really big moves with low volume, 12.4% positive move back here February 24th off of 54.5 million shares that traded hands. Another, what was this, 15% day off 75 million shares. Another 10% day off 51 million shares. You guys get the idea here. You're seeing big moves with low volume. So what do you think is going to happen when we see the next 200 million volume day? You're going to see the stock go absolutely crazy. And if we can break out of key levels, trigger some of that gamma hedging, that gamma squeeze activity, it's going to be really good. And it also looks like the MACD just slightly went bullish on Friday as well. So historically, when the MACD does go bullish, it's time to buy. When the MACD goes bearish, it is time to sell. So looking pretty good right there. That's really all I do have for this video. I wanted to cover those key things and keep this video really on topic and not 20 minutes long. So if you guys appreciate that, hit the like button, subscribe to the channel, as well as make sure to comment down below. Leave your thoughts on all of this. Your guys' input helps me to revise what I think to be true, and sometimes you guys can tell me something that I never even considered. So feel free to do that down below in the comment section. If you guys want to come trade with us, link down below in the pinned comment. Definitely lock in that price before the price does go up. Thank you guys for doing that. If you guys want to get those free stocks for less than the price of a McChicken or a Snickers bar or a bag of Lemonheads or Laffy Taffy, less than $1, right? You can sign up for Moo and get 3 free stocks as well as an additional free share of Neo upon you signing up. So check that out if you guys have not already. Thank you guys for doing all of that. You guys enjoy the rest of your weekend, and I will see you in the next one.